Welcome everybody, and till now we discussed so many sections under pgbp, but today we are going to discuss the most powerful section, and that is disallowed expenditure under section 40. Now what this section talks about, actually it says that section 30 is there. It will tell about rent, repairs, insurance of building allowed as deduction. 31 again will allow deduction. 32 will allow deduction of depreciation. 35 scientific research related expenditure allowed as deduction. Right? So when can that deductions be claimed? All that is discussed from section 30 to 36. 37, 38 also. 40 says that you have to do certain duties. If you don't do certain duties, then whatever deduction you are eligible for under section 30 to 37, we will not allow that. So suppose, because we are talking about pgbp chapter, obviously the person is a businessman, correct? Either he has taken state government's license, right, and doing a sole proprietorship business, registered as a HUF, maybe registered as a company, correct? Now when they make the payments, when they claim the expenditure under section 30 to 37, income tax department says that wait, we also gave you certain duties. Did you do that? If you say yes, income tax department says no problem, claim such expenditures as deduction. If you say no, I forgot, I did not do the duty, then income tax department says no, then we will not allow this expenditure as deduction. That means income tax will disallow. That means you would have till now deducted it in P&L account, shown it as expenditure in P&L account. So as per income tax, we should actually ignore, because you rightly debited it. But if you did not do the duties which are mentioned under income tax, then income tax will not ignore it. You wrongly deducted. As per our rules, if you don't perform your duty, we will not allow you to deduct. So what should we do? We will add back. What we will do? Add back. That means you enjoyed the expenditure as deduction, but the enjoyment is gone. Now what you have to do? You have to add that expenditure back if you don't do certain duties. Now you may be listening to duties from 2-3 minutes. What is the duty which I am talking about? Duty is to deduct the tax. Duty is to deposit the tax. Duty is to accept, or you should follow digital payments, right? Don't make cash payments, pay online, banking channel, account pay check. So like that, various duties are there which you have to follow. Now why government impose such duties on you? Because hey, India is a big country, or any country for say, has to bring everything in order, in a system, and for that everybody has to do something or the other as per the government's expectation, so that everything happens in a systematic way. Like government has to collect right amount of taxes, that should happen. For that you need to do some things. Government want everything to be online through digital mode, so that government can track the expenditure. So for that purpose also government impose certain duties on you. If you don't do that duties, then government will say you have to face these punishments. That is your expenditure, genuine expenditure which you incurred, which you want to claim it as deduction as per P&L account and as per income tax will not allow that. Add back, it will add back. That means your income will increase. Okay, so basically you understood this section is talking about all the disallowances. Now if you ask me, section 36 to section 30 to 36, what sections are powerful? 30 to 37 section or section 40 is powerful, right? Because 40 will tell add back, 30 to 37 will say deduct. Now what is right? What should you follow? So you should follow 30 to 37 for sure. But if 40 objects, then you cannot use this section 30 to 37. What this section 40 says? With notwithstanding anything contained in section 30 to 38. That means whatever said in section 30 to 38, we are least bothered. If you did not follow our duties, whatever we said, then your expenditure is disallowed. That means you would have debited in P&L account for computing your net profit, but for income tax that cannot be considered as expenditure. Okay, so let's start the discussion. First section talks about section 40A clause 1. What it says? Royalty, interest, fees for technical services. Hey, come on, say with me. Royalty, interest, fees for technical services. What I said? Royalty, interest, fees for technical services paid outside India or paid to a non-resident. Now where this is explained? Section 48 clause 1. Now what happens is royalty. Suppose you have taken certain software license, you pay some royalty. Or suppose example, you are publishing a book and that book you have taken it from a foreign author, so you pay royalty to a foreign author, right? You take some license from foreign country, for that you pay license fees. You take loan from foreign country, you pay interest outside India, right? So if you are paying royalty, interest, fees for technical services, you took technical services like you wanted some consultation on construction engineering, you want some consultation on design of a software, so you may pay technical fees to outside India, correct? So if you are paying royalty, interest, fees for technical services outside India, that means somebody is staying outside India, to them you are paying, or a company is outside India, to them you are paying, or you may be paying to a non-resident in India. Non-resident in India means he is now in India but he is a non-resident. And what is non-resident? You all know, correct? Very good. Now if you are paying to these people, then it's your duty that you should deduct tax, right? You are paying interest outside India, you are paying royalty outside India, so first deduct the tax. Okay, and don't keep with yourself, deposit with the income tax department. So your duty is just not only deducting the tax but also depositing it with the income tax department. Suppose example, you are paying 1 lakh rupees interest outside India, and when you check the TDS sections, which we'll discuss in the latter part of the lectures, 10% is the rate of TDS. So what you should do? Should you pay 1 lakh directly to the outsiders? No. You should calculate 1 lakh into 10%. So 10,000 will come. So you pay 90,000 outside India, correct? And 10,000 you keep with yourself. So first duty you did. What is the first duty? Deduct tax. Now what is the second duty? Deposit. Right? This 10,000 you should not keep in your pocket permanently. Go to the income tax department and deposit the money. Right? With the numbers or authorization numbers which the other person will give. Right? So once you deposit in the name of the non-resident or a person outside India with the income tax department, your duty is done. Now when should you deduct? You should deduct in the previous year itself. Now what is your previous year? 2020 to 23 is your previous year. So from 1st April 2022 to 31st March 2023 you should deduct. And when you should deposit? At least before filing income tax returns. Okay, if you deposit in the previous year itself 22-23, no problem, very good. But at least if you are late, deposit it before filing income tax returns. Right? Suppose if you are a company, then you should file income tax return till 31st October 2023. That means in the assessment year, 31st October 2023. Right? 23-24 is your assessment year. So if you deposit till 31st October 2023, it's okay. If you satisfy this condition, then interest is an expenditure, royalty is an expenditure, fees for technical services is an expenditure, claim it as deduction, no problem at all. But if you default in deducting the amount, if you default in depositing the amount before filing returns, then you will not get the deduction. The expenditure you incurred, you cannot claim it as deduction. So what will happen? If you have already debited to P&L account, that expenditure will be added back while computing income tax or business income. Simple as that. Now there are different types of defaults which happen. You did not deduct itself. Then what will happen? Then simply expenditure is disallowed, you have to add back. You deducted but did not deposit till the filing of returns. Maybe you deposited after filing of returns. Then what will happen? Then whenever you actually deposited after filing of returns, in that respective previous year, you can get the deduction of the expenditure. Okay. Now the question comes, your TDS, I gave the example that your interest payment is 1 lakh, TDS is 10,000. Right? 10% is the TDS percentage I said. So 10,000. Now 10,000 should be added back while computing your income, or 90,000 should be added back, or 1 lakh should be added back. Question correct? So the answer is entire 1 lakh. 100% of the amount is disallowed. Okay, very good, clear. Now the question comes, suppose example you are not sincere. Okay, wait a minute. 40A subsection 40A clause 1 I discussed it till now. Shall I discuss clause 1A and discuss the common point for these two? That would be okay for all of you, right? Now, so 40A is very clear, which we discussed till now. 40A talks about any payment of royalty, interest and fees for technical services outside India or to a non-resident, if TDS is not deducted, not deposited before filing income tax return, deducted in the previous year, deposited before filing income tax return, any default, the amount is disallowed. But once you comply with the provisions, okay, you did not follow this year, you followed for this item in the next year, okay, at that time you claim deduction, no problem. Income tax department is not an enemy for you. Only thing they want is comply. Once you do, they will give deduction. That's it. Okay. Suppose in the previous year 22-23 you should have deducted, and before filing income tax return you should have deposited. You can claim deduction now itself, in the same year itself. But if you deposit maybe in the December 2023, so after filing returns, okay, in 23-24 previous year, that is for 24-25 assessment year, you claim deduction, okay, no problem. But now come to point number B. B talks about that any payments to a resident, you are paying to whom? Resident, where TDS is deductible. Now where TDS is deductible, there are so many sections. There is section 192, 193, 194, right? Then 190, these are 196 sections are there, so many are there. And in that also then 194, 194A, 194C, 194D, 194D, so many sections are there. So if any payment you are doing to a resident where TDS provisions are applicable, then what you should do? As per section 40 clause A 1B, simply deduct the tax in the previous year and deposit before filing income tax returns. If you do this, no problem. If you don't do, then 30% of the amount is disallowed. Okay. So, is there any difference between A and B? Are you able to connect? In case of non-residents or payments outside India, 100% disallowed. But in case of B, when you are paying to residents, only 30% is disallowed. Now compare A and B again with the same example. Suppose 1 lakh is the payment which you should do and 10,000 is the TDS which should deduct and pay to the government. In A also same, B also same. If you default, then what will happen in case of A, non-resident or outside India? Simply add back 1 lakh rupees. But in case of B, when your payments are to a resident, 1 lakh into 30%. 30,000 will be added back, not 1 lakh. So in case of non-resident or payments outside India, entire 1 lakh added back. In case of payment to resident, only 30%, that is 30,000 will be added back. Now the question comes, ki sir, if suppose in the next years or maybe third year, fourth year, we deposited it with the government, can we claim deduction at that time? The answer is yes, you can. Okay, no problem at all. But only thing, please remember that whatever is disallowed, that much you can claim it as deduction. So in case of non-resident, you can claim deduction of 1 lakh rupees. In case of residents, that is B, you can claim the deduction of 30,000 rupees. So whatever was added back, once you satisfy the conditions, you can claim it as deduction. Clear or any doubt is there? Now, we will try to understand something which is very, very important. Suppose you did not deduct, but the other person is very much sincere. Suppose you have to make payment to Tatas but you did not deduct the TDS. So Tata is very sincere company, correct? So they filed the income tax return and they showed the income properly to the government, and they even paid the tax. Now, what the government says, I'm talking about B, that payment to resident, section 40A clause 1A, and that to note 2. Okay. Now Tata has deposited. So when Tata has already paid the tax, why you should be punished when the government's job is done, right? Why government want you to deduct tax? Because maybe the other person will pay or not. But if other person has already paid, then why you should suffer? Government said no need to suffer. Government simply said, okay, did the receiver, that is payee, file the income tax returns? Did the receiver pay the taxes, relevant taxes for that? And the payee should get a certificate from the chartered accountant that in relation to the TDS what you should have deducted, you did not do, but at least the payee has filed the income tax return and paid the taxes. Once they get the certificate from chartered accountant and give that certificate to you, you submit to the income tax department. Then income tax department will say, okay, no problem, we will allow you the deduction now. Correct? Very good. Under section 200 we have seen this. Now, government will allow you the deduction. But government will deem that you are not in default. Okay, government will deem that you are not at all in default. आपने कुछ भी टैक्स की चोरी नहीं की. If the other person pays the tax and gives you the certificate from chartered accountant. But when the TDS is deducted, actually not deducted, correct? But when the government deems that the TDS is deducted, the time when Tatas filed the income tax return. Okay, when the Tatas filed the income tax return, at that time you deducted the TDS and deposited with government. That's what the income tax department deems. Okay, very nice. But because you should have deducted some time before, so whatever delay is there, for that 1% interest you should pay. This is what the B point is in totality with notes I discussed. Okay. Now come to C, where equalization levy is applicable. Section 40A clause 1B, it is simply talking about one thing, that is equalization levy. Now many of you don't know this word, so I'll explain first. Actually, we do a lot of advertisements on Facebook, YouTube, Google ads, Instagram ads, right? Or social media ads. On Pinterest you can do some ads. Rumble is there, on that we can ads are there. There's so many websites on which ads campaign can be run. Most of these companies are outside India, correct? So if you are doing ads, you are making payments to this social media companies, whether it is Google, Facebook or many others. If your payments exceed 1 lakh rupees, then government says that you should deduct equalization levy. So equalization levy is nothing but TDS only, but only thing the name is changed, correct? And not only deduct but also deposit with the income tax department. If you do this, no problem, you can claim that expenditure of advertisement as deduction. But if you don't do, then government says that your advertisement expenditure on digital marketing expenditure will be disallowed. Okay, simple as that. Now come to the income tax section 40A clause 2. What it simply says that income tax includes surcharge, income tax includes cess, like health and education cess. So if any income tax you are paying, or you are paying interest on income tax, or you are paying fees under income tax, or you are paying penalties under income tax, or you are paying surcharge under income tax, or you are paying health and education cess or any other cess under income tax, there is no other, but still in all these cases in P&L account you can deduct it, debit it, but income tax says disallow. Disallow means what? Add back. Okay, not allowed as deduction, right? And this health and education cess is added from this year itself, right? From assessment year 23-24. That's why I underlined it, amendment. And the best part of it is the amendment is from retrospective effect. That means from 1st April 2005, I feel. Yes, I am right. So from that date, if any health and education cess you would have paid, that you can claim it as deduction if you have not filed the income tax return, right? If you have option to revise it, you can revise it also. But anyhow, simply remember from your exam perspective, it is very clear. Income tax, interest on income tax, right? Penalties of income tax, fees under income tax, cess under income tax, surcharge under income tax, right? Or any interest on loan taken to pay income tax, interest on loan taken to pay advance tax, or any advance tax paid, any TDS paid, anything, TCS paid, you cannot claim it as deduction, entirely disallowed. So if you are showing it under P&L account debit side for business income computation, add back. Now come to E part. E part is very simple, wealth tax. Simply talk about it, section 40A clause 2A. Wealth tax, add back. F, wealth tax has been deleted many years back, just it is there, so we are talking about. F, suppose state government undertakings are there, state government companies are there, right? Undertakings means simply companies. Pay some royalty, license fees, privilege fees to the state governments. In that case, what will happen? That the expenditure, that means whatever the amount they are paying, will be disallowed. Here there is no condition at all. There is no condition, simply disallowed. There is nothing called as deduct TDS or deposit with the income tax department. Nothing as such. Unconditionally disallowed. Okay. There are a lot of reasons behind it. Basically what happens is when central government collects all the taxes, income tax, out of it some part will go to state governments also. Now when state governments are collecting something, earning something, and state government undertakings are paying to it, if they claim it as deduction, then income tax department will collect less tax, and when they collect less tax they will have some less share. So that's why what they said, it is disallowed. That's it, nothing more than that. So remember very simply what I said, that any royalty, license fee, privilege fee, service fee, whatever it may be, state government undertakings are paying to the state governments, then under section 40A clause 2B, disallowed. That's it. Now you may ask me, what are state government undertakings? There are some 5 points they said. If suppose any corporation is created, like Telangana Electricity Corporation, right? If it is a corporation is created by the state legislative assembly, right, by the state government, then obviously it is state government undertaking. Or suppose there is any company in which state government has purchased not less than 50% of the equity shares, not less than 50% of the equity shares, then in that case we can say that is also state government undertaking. Or suppose there is a company in which either the A point which I said, that is corporation of state government, or company of the state government, or even state government itself, any of these three people together purchased not less than 50% of the equity shares, right? In that case also we can say that, क्या बोल सकते, that company in which all of these three together or individually has purchased not less than 50% of the equity shares, then it is a state government undertaking. Suppose state government controls the directors in a particular company, at least 50% of the directors state government can appoint, then also we can say that yes, that organization, that company is a state government undertaking. Or if it is a body, if it is a body, institution, or any type of entity in which central government has at least 50% of the voting power, right, 50% of the control, it is state government undertaking. So if such state government undertaking pays any royalty fees or privilege fees to the state government, that is disallowed, added back. This is unconditional disallowance. Okay, very good. Chalo. Now let's see this point G. What it says? Hey, it simply says that you make payment of salaries. Now to whom you are making payment of salaries? To any person outside India, or maybe to a non-resident. Now for that you need to deduct the TDS and deposit the TDS. But here there is a catch. The point is, till now whatever you discussed, you should deduct the TDS in the previous year and deposit the money before filing income tax returns. Correct? That's what we discussed till now. But here the condition is so strict. Okay, one more thing. Deduct the TDS in the previous year and deposit the TDS till filing of income tax returns. This is what the two conditions. If you satisfy, it's okay. If you fail, at least in the next year you deposit the money with government, government will give deduction. This was happened till now. But in case of salaries, government is extra strict, right? Because most of the income tax is paid by salaried people only. So what government says, deduct the TDS, deposit the TDS before the due date of filing TDS returns, right? Before the due date of filing TDS returns. If you don't do so, TDS returns 7th of the next month. If you don't do so, then the salary paid is disallowed, and that too permanently. That means later on if you deposit also, you will not get the deduction. Okay, that's what the special part about it. Section 40A clause 3. What it talks about? Payment of salaries to a person who is outside India or who is a non-resident. You should deduct the tax in the previous year and deposit the TDS before the TDS return due date. If you fail to do so, you will not get the deduction of salary. That means you debited salary to P&L account, right? That should be added back. Not only that, next year if you comply the conditions, still you will not be getting the benefit of deduction, right? This is super strict, right? Government, wherever they get more money, there they should be very strict, and they are. That's it. Now come to the next thing. Payment of provident fund, right? Provident fund related payments are there. For that, this section 40A clause 4, right? If provident fund related amount related to that or any other fund like NPS is there, maybe ESI is there, anything relating to it, if any TDS has to be deducted, it should be deducted, it should be deposited. If no proper arrangements are done for depositing the TDS, then government says the payments are disallowed. Clear? Shall I go to the next point? Simple. Remember, provident fund contribution employer-employee makes. This is common. But when employee makes the contribution, employer makes the contribution, that has to be deposited in time, right? And one more thing, when employee withdraws the money from the fund, at that time, if it is taxable income, at that time TDS should be deducted, TDS should be deposited with government, otherwise the payment will be disallowed. Okay, shall I go to the next part? Suppose employer gives you non-monetary benefit. You are an employee under section 48 clause 5. Who gives? Employer gives non-monetary perquisite to you. Maybe he gives you a TV, maybe he gives you a gold chain, something like that. Non-monetary, which is not money but an asset. If they give, then it is a taxable perquisite, correct? Under the salaries chapter, it is taxable. But now please remember, even if it is taxable, the employee should pay tax on it. But employer was so kind that he said that okay, no worries, even tax also we will pay. You take the benefit and whatever tax come on that benefit to the employee, that also employer is paying. Now the question comes, can the employer get the deduction for the perquisite given to employee? Right? Suppose gold chain is given worth 1 lakh. Can he claim the deduction for that 1 lakh? The answer is absolutely yes. Second question. On that 1 lakh, suppose some tax comes around 10,000 rupees. Roughly. Okay. If that 10,000 employer only paid to the government on behalf of the employee, can he claim this 10,000 as deduction? The answer is absolutely no. The reason being, actually, it is exempt in the hands of employee under section 10(10)(c). Any tax paid on non-monetary perquisite is exempt in the hands of employee under section 10 subsection 10(c). C double, right? So if it is exempt in the hands of employee, it is not at all taxable, so employer will also not get deduction. I know you got literally confused. Again I am repeating for you, listen carefully. Now you will get full clarity. Hey, what happened? Suppose I am employer and with me Jagadishwar is an employee. what I did, I gave him non-monetary perquisite. I gave him, अरे यार अब gold chain थोड़ी दूंगा उसको, right? लड़का है, right? He's a boy. So boy के लिए why should boys have all the fun? Okay, I gave him a bike as gift. चलो 2 lakhs worth bike I gave him as non-monetary perquisite. Employee happy, and boys get bike, yes, super happiness. Now on that he has to pay some tax around 40,000. Okay, so I not only spent this 2 lakhs to purchase the bike for him, but I also paid 40,000 rupees on behalf of the employee as tax. Now what will happen to Jagdish in this case? He has all the fun because he got a gift of bike, and double fun because on that whatever tax is there, that also I only paid. So he again need not even pay tax. And the triple fun, it is exempt under section 1010 CC for Jagdish. That means even 40,000 is a benefit, right, which he is getting from me. On that there is no tax, it is exempt under 1010 CC. So Jagdish has triple fun, but I only have tension because that 2 lakhs as an expenditure I can claim as deduction because I gave a non-monetary perquisite to employee. But this 40,000 I cannot claim as deduction, right? That's what section 40A clause 5. I feel clear? So everything in section 40 we just tried to cover till now. Hope you enjoyed. Right? Now let's go to the next section. What it says, that if you are paying anything excess to your relatives or to related person, rather than relative, related person is more correct. Okay. But if income tax return book write like that, what should I do? Whatever they wrote, accordingly I wrote. But understand that excess payment to relatives is written, but it actually means related person. Okay. Section 40A subsection 2. Now here when I say A, it is capital A. Till now also A came, but all were small a, small a. But now it is capital A. Difference should be there. इधर छोटे को बड़ा, बड़े को छोटा कर दिए तो इनकम टैक्स वाला मार्क को टुक 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 जीरो कर देता, right? So income tax will not award you marks if you do this silly mistake also. Really cannot say silly, but बोलना पड़ता है, right? What actually happens is, we discussed 40A clause 1, clause 1A, 40A clause 1A, 40A clause 1B, 40A clause 2, 40A clause 2A clause 2B, 40A clause 2B, right? Then 40A clause 3, clause 4, clause 5, all that we discussed. But till now whatever way we discussed, it was small a, chotu wala a. Okay. And now when we are discussing that excess payment to relatives under section 40, it is capital A, bada wala A. Okay. And in bracket 2, subsection 2. Now what it says, that any payment you make to your relatives or related persons in excess, which is beyond reasonable, it is disallowed. How much disallowed? Excess payment is disallowed. Now this disallowance is at the option of the assessing officer, income tax officer. If he considers to disallow, he can. If he considers to ignore, he can. It's his choice. So we can say this is a discretionary power of assessing officer. Okay. Now, so our exam perspective, we will just write it is a discretionary power, but for our exams it is compulsory to disallow. Suppose in P&L account they write to rent payments, and in adjustment they give, suppose in P&L debit side they wrote 2 rent payments, suppose 1,80,000. In adjustments they write that the rent payments are made to his wife and the fair market value, the fair rent of the building is 30,000 rupees only. That means you should have made the payment of 30,000, but you paid how much? 1,80,000. My God. So the extra 1,50,000 is there, na? That should be added to your net profit to get your business income. Okay, understood? But now, who is related person? To understand this, we need to understand two terms. One is relative. Who is relative? Are relative? Me, my wife, that is spouse, my brother, my sister, my lineal ascendant, lineal descendant. What does it? Self, spouse, brother, sister, lineal ascendant, lineal descendant are all called as relative. Now, who are persons having substantial interest? Simple language. 20% you should remember. What I said? 20%. Suppose if it is a case of company के केस में याद रख लो, right? If you hold 20% or more equity shares, अरे प्रिफरेंस नहीं रे बाबा, इक्विटी याद रखने का, ठीक है? If you hold 20% or more equity shares in a company, then we can say you have substantial interest in the company. Correct? Whoever has 20% or more shares in a company, they have substantial interest. Mukesh Ambani holds more than 20% shares in Reliance Industries, so Mukesh Ambani has substantial interest. Adani holds more than 20% shares in Adani Enterprise, so Adani is wrong, Adani is right, right? They are great businessmen, so they are having substantial interest in Adani Enterprise. Gautam Adani has. Okay, this is the case of company. But suppose our business is partnership, sir, then we will not see 20% equity share capital, but we will see, because partnership don't have equity share capital, right? How can we see equity? We'll see PSR. PSR means profit sharing ratio. So if you have 20% or more profit sharing rights in the partnership, then we can say that you have substantial interest in partnership. Suppose it is not partnership, but it is an association of persons, a club or a trust. If you have 20% or more voting power, 20% or more voting power, then we can say you have substantial interest in that AOP or the club or whatever it may be. Right? So we understood substantial interest, we understood relative. Come on, repeat with me. Relative means self, spouse, brother, sister, lineal ascendant, lineal descendant. Correct? Substantial interest means in case of company having more than 20% of the equity share, 20% or more equity share. In case of partnership having 20% or more PSR means profit sharing ratio. Now, who is a related person? Let's deep dive into it. Very easy, will not spend much time. For individual, his relatives are related persons. Any doubt? For individual, relatives are related persons. Simple? Very good. If suppose the individual has substantial interest in any company, then the company and individual are related persons. Like Ambani individual, Reliance Industries company. Related persons. Okay, shall we go to second one, company. The director of the company and the relatives of the directors of the company are related persons. So can I say that Reliance Industries and the director Mukesh Ambani and Mukesh Ambani's wife Neetu Ambani are related persons? Absolutely yes. So for company, the relatives and for company, the directors and directors relatives are related persons. If suppose you have 20% or more equity share capital in the company, you have more than 20% equity shares in the company, or maybe okay, you have more than 20% equity shares in the company. That means you have substantial interest in the company. So you are a related person. Maybe you are a director of the company, you are a related person. You are relative of director for company, you are related person. You are holding 20% or more equity share capital, you are a related person. Now, X Limited is holding shares 20% or more in Y. So X and Y are related. X Limited also holds 20% or more shares in Z Limited. So X and Z are related persons. Not only that, but Z and Y are also related persons. Father has two children. So child 1 and father are related person, child 2 and father are related person, child 1 and 2 both are related person. That's simple way you try to remember. Okay, shall we go to the third part? In case of partnership firm, partners and their relatives are related person. If partners and their relatives are related persons, if partner or relative hold 20% or more interest in another entity, then that entity and this partnership firm are related persons. Right? Please remember, that entity and this partnership firm are related persons. Clear? Without? No doubt. Same way come to HUF and AOP. Now HUF will have family members are related persons. Then for association of persons, which we already know, the members are related persons. In both the case, common thing. If a member, or in case of HUF again member, AOP also member, hold 20% or more substantial interest, simply say voting power, hold, power, control, right? If you have how much, 20% or more, then you are related to the HUF or AOP. Okay, suppose 20% or more voting power you have in suppose a company. You are a member of AOP and you have 20% or more voting power in a company. Then that company and AOP are related persons. Like that also it works out. So we understood about individual, we understood about partnership firm, HUF, AOP, one and the same. Right. So we discussed about four things. Fifth thing, other SSC. Now who can be other SSC? Suppose a club is there, right? Sports clubs, gymkhana club, something like that are there. Or there can be something called as a trust also, right? Now charitable institutions are there. So for this type of SSCs we use the word other SSC. If the individual has or his relatives which are connected to other SSC has substantial interest in the other SSC, they are related persons. If it is a company has substantial interest in the other SSC, then they are related persons. If suppose partnership firm AOP HUF has substantial interest in other SSC, they are also related person with other SSC, with the club. If suppose the director of the company or their relatives together hold more than 20% of the interest in other SSC, then not only the director and their relative are related persons, but even the company is a related person to the SSC. थोड़ा सा कॉम्प्लिकेटेड लग रहा है? कुछ नहीं, सिंपल, राइट? ट्राई टू रिमेंबर. How can you remember? Simply remember that if suppose you have control over other and you are a member of another, that other and another are related person, right? Your friends listens to you and your friend listens to you, right? And another person listens to your friend. So now indirectly what happens? They both listen to you. This is how the logic is. Okay, chalo. Other SSC, individual has substantial interest, HUF, AOP or their members have substantial interest, company has substantial interest in other SSC, then they are related persons. If directors have substantial interest, then directors obviously are related persons, but company also become related person. If partners have substantial interest in other SSC, then not only partners are related persons, but the firm also is a related person. Same applies to AOP, HUF. Right, very easy. Now if suppose excess payment is done or unreasonable payments are done, how to decide that this is unreasonable payment? The answer is quite simple. What is the fair market value of such goods and services? If you know the fair market value and you know what is the actual payment done to the related person, compare that. Then in that case you will be able to decide what is excess or unreasonable. Suppose the rent which you are paying to relative is 1,80,000, but normal rent, market value rent, fair rent is only 30,000. So that extra 1,50,000 is there, na? 1,80,000 minus 30, that becomes excess payment to relatives and disallowed. That means if in P&L account you wrote 1,80,000, right, then you should add 1,50,000 to your net profit to come to business income. Okay, and last thing which we have to discuss, suppose you sold the goods to your relatives at a discount. You sell the goods to your customers normally at 100 rupees, but you sold it to your relative for rupees 60. Now what should we do with this 40? Should we disallow it? You may feel yes, but the answer is absolutely no, because the disallowance is for payment. Disallowance is for payment, and here what we are doing, it is receipt from the customers. So for revenue this rule will not apply. You are transacting with related persons. If you are a person who is getting revenue, then this section will not apply. But if you are a person who is spending, right, expenditure, then this section will apply. Right, in the note what they said, if it is expenditure, then this section will apply. Okay, this way you should remember. Now consequences, if you are making the payment in excess of rupees 10,000 otherwise than by an account pay check, demand draft, electronic demand draft or electronic mode or any other prescribed mode. 40 capital A subsection 3, and we will also understand 3A subsection 3A. What is this actually? Hey, what happens is, till now, many years from independence till now, all the businesses were to happen through cash. Everybody was happy, but the only one who is not happy is government, because government was not at all getting taxes. And if government don't get taxes, can they maintain defense, military, right? Can they build infrastructure? All that practically possible? What happened? Jawaharlal Nehru was telling हिंदी चीनी भाई भाई, and भाई पीछे से आके चाकू भोंक दिया. Right? China captured lot of lands of ours. Manas Sarovar, the great temple, is not in our control now. Because when China attacked, we were not at all prepared. Now, police, infrastructure, military was not at all totally ready for it. Even they were not even properly supplied food. Why? Because government did not have money, nor even the intent at that time. But this government understands that government need money. So what government said? If government has to properly collect taxes, then business should happen online. Yes or no? If it is in cash, then they can escape. But if it is online, government can track. For that purpose, government brought this section 40 capital A, subsection 3 and 3A. So what happens? So you are given certain modes for making the payment. If you want to make the payment through account payee check. If you want to make the payment, DD, right? You can pay account payee demand draft. Not a problem. If you want to make payment, okay, you make through electronic mode. You pay through UPI, right? UPI, मालूम है ना, भीम UPI. World is fan for that software. They are asking source code. Modi ji says no. ऐसे हम ना देंगे, right? So that's what the power of our country now. And you also become powerful because there is great earning opportunities now. So what happened? So what happened is, if you have to make any payment, you make through account payee check, demand draft, right? You make the payment through electronic mode, right? Any other prescribed mode. Prescribed mode is nothing but UPI as of now. Now this way, if you are making payment, no issues at all. That means, can you make payment through cash, bearer checks? The answer is absolutely no. Up to 10,000 rupees payment, it's okay. Up to 10,000 rupees payment, it's okay. Single transaction in a single day, up to 10,000 rupees if you make in cash payment, government says not an issue, right? Some relief should be given, right? So government said up to 10,000 you can pay. That's not an issue. But if the payment is more than 10,000, compulsorily account pay check, demand draft, or through ECS or electronic mode. UPI is okay. Now come to the understanding part. Suppose if the payments are to be done to plying, hiring, leasing goods carriage vehicle, that means you are making payment to road transport operators. They travel, right, a lot, and they may not have proper internet facility with them too. So that's why government said okay, we'll allow in cash, but simple rule is up to 35,000 rupees. So if you see the analysis, for plying, hiring goods carriage vehicles, up to 35,000 single transaction in cash is okay. Beyond that should be through account pay check, demand draft. If beyond that you make in cash, suppose you paid 60,000 in cash, entire 60,000 is disallowed. That means in P&L account debit side you write 60,000, but income tax says add back, increase the profit, business income. So government don't feel credibility. That's simple thing. हम भरोसा ही नहीं करते भाई तुम पे ऊपर. Will not trust you if you are making in cash. So add back. Okay, entire amount, thoda moda nahi, right? Not partial, total, 100% add back, right? This is what government's rules are. Clear? Very good. Shall I go forward? If it is road transport operators, then 35,000 is the maximum limit. Okay, clear? Now, when I said this 1035 limit, single day, single transaction, single bill. What I said? Single day, single transaction, single bill. If these three are okay, then more than particular limit, that is 10,000 oblique 35,000, should be through online mode, account pay check, demand draft. Less than that can be through cash. Okay, clear. Now what happened? I made the payment for one bill to a customer, but when I made the payment is less than 10,000. So will government allow it as deduction? The answer is yes. I made the payment to a single person, but the payment is more than 10,000, right? I paid 30,000 rupees, but I made 4 bills, and for 4 bills the amount came to less than 10,000. Is it allowed as deduction? No problem at all. If you have multiple bills and each bill is less than 10,000, then no problem at all. Suppose I made partial payment through account pay check. Suppose I have to purchase some TV for 2 lakhs rupees. I gave check, but I have to pay certain extra amounts. Some part I paid in cash too. Then what government says? No problem, but the cash portion should be less than 10,000. Okay, if cash portion is more than 10,000, will entire amount of the bill be disallowed, or entire cash payment only will be disallowed? The right answer is entire cash payment only. Suppose I paid 2 lakhs rupees through account pay check, 15,000 through cash, then what is the disallowed amount? MCQ question to you. 2 lakhs 15,000 option A, 15,000 option B, 5,000 option C, 10,000 option D. बोलो तो entire 15,000 you paid in cash, that is disallowed. This you should be able to understand. Okay. Now to disallow it, first there should be allowance, right? Suppose if you got a invitation to the marriage, then you have option to decide whether should I come or not, to reject or accept. But if you did not get the invitation, then do you have any option? No option. Same way, under section 30 to 37, if expenditure is allowed as deduction, then only this disallowance should be thought about. Should we disallow or not? If deduction is not available under section 30 to 37, then this section is nothing to be talked about. जरूरत ही नहीं है बात करने की. No need to talk about. Correct? Clear? Are you able to understand what I said? Now, suppose you have to make payment. You paid the money in multiple days, and every time it is less than 10,000. Single bill but multiple days, and the payments are less than 10,000 each. Then 100% no problem at all. Multiple bills on same day but less than 10,000, no problem at all. If you are paying partially through account pay check and partially in cash, but cash less than 10,000, no problem at all, right? So you should be very careful with the provisions. The problem arises if it is single bill, single person, single day, more than 10,000 in cash, then only problem. Only one situation there is a problem. Okay, clear to all of you, yes or no? So we understood all these other points also. Now let's see, there is something called as rule 6DD. What is this rule 6DD? This rule 6DD says that you make payment to certain persons, certain cases. This 10,000 rule, 35,000 rule does not apply. Suppose you, why government brought this section? Only government should have proper track record business should continue to be documented through online transactions so that people cannot escape taxes easily. But suppose if the person is paying to Reserve Bank of India itself, or to a banking company, or paying to State Bank of India or its subsidiary, or paying to LIC Life Insurance Corporation, or paying to cooperative society, or paying to agricultural cooperative credit society, or any other credit society, credit cooperative society, or paying to a farmer, agriculturist, or paying to a person who is engaged in meat production or fisheries or horticulture, right? Or you are paying to somebody on a banking holiday, Sunday. In these cases, can we expect that account pay check through payment can be done? Sometimes may not be, and sometimes restricting is under. If somebody is paying to RBI or State Bank, it is documented with government, right? Somebody is paying to agriculturist also is documented through mandis. So what should we understand? That if you are making payments to particular list of persons, which we will discuss, the payments, even if it is in cash, it is not disallowed. That means cash payments are also allowed. Suppose you are paying to your employee gratuity, retirement benefits, but the total benefits are less than 50,000 rupees. Are you pay in cash? No problem at all, right? So why? Because small amount यार, retire हो गया, बूढ़ा हो गया, उसको छोड़ दो ना, cash में दे दो ना. If it is less than 50,000, then government says no problem. More than 50,000, then it should be through account pay check. So like that, there are multiple points which I may not be able to remember. So shall we read together? That would be great, right? Hey, now let us fatafat do this list, because it's just to remember roughly, not again exactly, or they will not ask question to you that list out the persons on whom section 40 sub 40A subsection 3 clause or 3A will not apply. Such type of list they will not ask in exam, so you have to just roughly remember the list. Okay, and let's start with the discussion. Okay, hey, I did not discuss with you 40A in bracket 3A, that I'll discuss, don't worry. Okay, chal. Now, if you have made the payment to Reserve Bank of India or to any banking company, if you have made the payment to State Bank of India or to its subsidiary, or you made the payment to cooperative bank or to a land mortgage bank, or you are making payment to primary agricultural credit society or any primary credit society, or you are making payment to life insurance corporation, in all these cases what you should remember, that even if the cash payment is more than 10,000 or 35,000, doesn't make a difference, you can claim the deduction. Okay, right. Next, similar to that, there are many other items, like where the payment is made to the government. Now you make the payment to government, where is the element of doubt? Or government only said that you make the payment through legal tender, that means Gandhiji wali note. Then when government itself said that you make the payment through legal tender, that is cash, or government only is receiving the amount, then allowed, right? Even if it is paid in cash. Now, where the payment is made by, who makes the payment? Now, till now, the first A and B, we just spoke about the receivers. If these people are receiving, that means RBI is receiving, State Bank, Cooperative Society, Primary Agriculture Credit Cooperative Society, LIC, government, right? If these are receiving, which are given in A and B, then you may be the payer. you can claim deduction even if you pay in cash. But now they are not talking about receivers, they are talking about payers in C point, right? Where the payment is made by. That means if this list of people make the payment, they can claim the deduction even if it is in cash. That means 40A subsection 3 does not apply for people who are making payment in this category. Right. Now, if suppose you are making the payment through letter of credit, this is actually given by the bank. Suppose example, I'll tell you the biggest scam relating to letter of credit. Nirav Modi took lot of loans from foreign banks. Now our Punjab National Bank gave letter of credit that if Nirav Modi don't pay, then Punjab National Bank will pay. And that's why Punjab National Bank suffered a lot. Because there is a proper procedure to actually issue letter of credit, but they did not follow because internal corruption was there. So if you are making any payment through letter of credit, which Nirav Modi was doing, right, for purchasing goods from foreign country, then obviously what happens is, even if you are paying in cash or through letter of credit, it is allowed as deduction. They will not see that array, it is not account paycheck, it is not demand draft, it is not electronic clearing, it is not the electronic mode which we said, so that's why we'll disallow. Nothing like that. Array, it is not account paycheck, agreed. It is not demand draft, agreed. It is not uh, any electronic mode which government prescribed, agreed. But still the expenditure is disallowed. Sorry, still the expenditure is allowed. Still the expenditure is allowed. Right? If it is letter of credit, if it is through a mail or telegraphic transfer, right? If it is through book adjustment, suppose I have to pay 10 lakhs to you, you have to pay 15 lakhs to me. So shall we cancel this 10 lakhs and you only pay 5 lakhs to me? Right? If these book adjustments are there, then even though it is not account paycheck or demand draft, it's okay. Right? You can get the deduction. If the payment is through bill of exchange, it's okay, you can claim the deduction. If it is through electronic clearing system, it is not account paycheck, right? It is not demand draft, right? Still, if your payment is through electronic clearing system, then it's okay, it's allowed. If it is through credit card, debit card, it's allowed. Okay, you can claim deduction. Now come to D point. Let's see D. Where the payment is made by way of adjustment or a book entry only, right? Again, adjustment of any liability, right? That same book entry related point only. So let's go forward. Where the payment is made for the purchase of. So now this E item is not talking about who is making the payment, to whom it is made, right? Who is making the payment is discussed in C. A and B discussed to whom the payment is made. But here E is talking totally about what is the product. If the product is agriculture or livestock product, if the product is produce of animal husbandry including livestock, meat or hides or even skins, right? If dairy or poultry farming also is covered, if it is fish or fish products, if it is products of horticulture like we can say flower making or agriculture in the cultivation, growing or producer of such articles, produce or products, then in all, if these are the products, then no problem, who is making payment doesn't matter, to whom the payment is made doesn't matter. But if these products are there, then definitely cash is also allowed. other than account paycheck, other than demand draft, other than any prescribed mode is also allowed. Any mode is allowed. Okay, no restriction. 40A3 doesn't apply. Now F is a point which we should check. Any payment which is made for the purchase of products manufactured or processed without the aid of power in a cottage. So in a cottage, if the production is going on without power, right? For plant and machinery, there is no power, manual labor work, right? Then the producer of such products, where the payment is made for the purchase of the products. So we are purchasing some cottage related products and we are making payment to the producer, right? And the producer is producing without electricity, that means without power, then definitely it is allowed as deduction, right? Next, because ultimately government wants to encourage this type of businessmen, right? Cottage village industries should be encouraged. So this is how income tax department encourage. G point you check, where the payment is made in a village or town which on the day of such payment has no banking facility, not served by any bank. So bank holiday on that day. So definitely more than 10,000 can be, or right, any payment can be made and no restriction of 40A3. Do any person who ordinarily resides or is carrying on any business, profession or vocation in any such village or town. So that's it, very simple. On that day banking is not there, in a village or rural area they are talking about, that's it. Then the payment will be allowed. 40A3 doesn't apply. H point you see, where any payment is made to an employee. Now we are paying to the employee of the assessee or the heir of any such employee. An employee died, his legal representative, on or in connection with the retirement, retrenchment. So either the employee retired, he was removed, that is retrenched, or he has given resignation, right? Or the employee is discharged from the duty, or maybe employee has died. So the entire amount of gratuity we are talking about, retirement benefits we are talking about, if they are less than 50,000 rupees, that's okay, yaar, it can be paid in cash, right? Next thing, see I point, where the payment is made by an assessee by way of salary to his employees. So whatever TDS has to be deducted under 192 section, they deducted the TDS and deposited it with the government, and salary is paid in cash, then definitely it is allowed as deduction, right? That's how you should remember the topic, right? And when it should be paid, if suppose salary is paid in cash and TDS is deducted and deposited with government, because the employee is not working in usual place of business, employee is working in some remote area where banking facility is near, banking facility is not there, or he don't have bank account in that area, right? If these type of situations are there, how can he survive, right? So that's why government said okay, in this case you can pay through cash also to such employees for such period again. Okay, let's go to J, where the payment was required to be made on a day on which the books were closed. So if books are closed either on account of holiday or strike. So if it is holiday or strike and books are closed, you don't have any option except to pay in cash. Online you cannot anyhow. Right? Strike was there, holiday was there. Where the payment is made by any person to his agent. Now you are the principal. You are making payment to agent. Agent has to make payment to the farmer, agriculturist, poultry farming, right? Horticulture, to such people. Then what will happen? You also can make payment to your agent in cash. The only condition is, remember, only condition is that agent should pay to these people in cash. Where the payment is made by an authorized dealer. Suppose you are a money changing agent, then definitely you can deal in cash. Government allows you. Now we have certain examples to go through. Very easy. Whatever I discussed till now, same thing covered. Okay. If suppose 3A covered here, I'll just explain here itself with examples. Okay. So points to be kept in mind. So regarding 40A subsection 3, what points you should keep in mind? And we'll try with an example. Understand with an example. One more thing I'll tell you. When you solve long problems, pgbp 10 marks, 12 marks problems, at that time this section really is very important. Okay, super important. So chalo, let's continue with, if an assessee makes payment to Mr. X against a bill of rupees 50,000 on a same day, but at a different time, but each time the amount of payment does not exceed rupees 10,000. What happened? Again, try to reconnect. What is the principle which is important here? If an assessee makes payment to Mr. X, okay, this is normal, against a bill, yani single bill here of rupees 50,000, it's okay, on a same day, but at different time, but each payment, each time the amount of payment does not exceed 10,000. Now, on a single day you paid on a single bill to a single person, right? One single payment may be less than 10,000, but all payments together will be checked, right? Because it is single bill, because it is same day, because it is same person, same day, same person, same bill. How can be multiple payments on the same day? Not possible, right? So that's why government said entire amount is disallowed. Clear? Shall we go to next? If an assessee makes payment of two different bills, please see, two different bills. One of them exceeds rupees 10,000 at the same time to the same person in cash. So provision of section 40A is not attracted. So provision is not attracted. Why it is not attracted? Tell me. Because there are different bills. And none of them exceeded rupees 10,000. Okay? Right. Now X paid to rupees Y rupees 12,000 in cash against his bill. One minute here. I feel I got it. X paid to Y rupees 12,000 in cash. Okay. Against his bill. Okay. Number 482 of rupees 7,000 and bill number 572 of rupees 5,000. Nothing. Okay, you tell me. All amounts are less than 10,000, right? That's why the answer comes nothing shall be disallowed under this section. How can we disallow? Because all payments are less than 10,000. If an assessee makes payment to a single bill, so payment is on a single bill, right? Exceeding rupees 10,000. 10,000 से ज़्यादा है. But the payment is done on different days to the same person. We discussed this or not? If the payment is to different the days on different days, the provision of section 40A subsection 3 is not attracted. Why it will attract? Because each payment does not exceed 10,000. Now you pay in multiple days, that's okay, but each payment should be less than 10,000, right? Now let's continue with the next story. X paid to Y. Who paid to Y? X paid to Y in cash. Cash में पे किया against bill number 421 of rupees 23,000 as follows. So X paid to Y, total 23,000 they are telling. On 17th December 2022, 8,000, then again 9,000, then again 6,000. So obviously it is less than 10,000, so no disallowance. So nothing shall be disallowed, they said. Let's go to next thing, where payment is made over rupees 10,000 at a time, partly by account pay check and partly in cash, but the payment in cash is less than 10,000 rupees. So obviously if it is less than 10,000, then if it is in cash and less than 10,000, then we can claim deduction, no disallowance, है ना? Right. X paid to Y against bill number 712 of rupees 50,000 in form of account pay check. So account pay check rupees whatever amount it may be, bearer check is 3,000. So it is less than 10,000, so it is allowed as deduction. Cash 5,000. Less than 10,000 allowed as deduction. So nothing is disallowed. Okay. Shall I go to next point? If part of the expenditure is already disallowed under any provisions of this act, sometimes what happens? You default in some things, so part of the expenditure is disallowed. Then disallowance shall be calculated on the allowed portion of the expenditure. So whatever is allowed, only on that portion expenditure is deductible. Right? Very good. Shall. 1 minute. So suppose under same section 40, some expenditure is there which is disallowed. So disallowance shall be calculated on the or allowed on proportion. Chalo, let's see what they are telling. X purchased goods from his brother of rupees 14,000. Okay. Market value of which is rupees 8,000. Now X is making the payment which is in excess of the fair market value. So fair market value 8,000 and you are paying 14,000. So this 6,000 is excess. So that's why this 6,000 will become disallowed under section 40A subsection 2 and paid in cash. Rupees 6,000 shall be disallowed under section 40A subsection 2 and nothing shall be disallowed under section 40A subsection 3. Why? Because already disallowance is there under other section which is rightful, right? And that's why no need to again disallow it. Can same item be disallowed two times? Because same income cannot be taxed twice. So same expenditure cannot be deducted twice. That's it. With this, let us go to the next part. Okay, what they said. There are 3-4 more cases. I feel very big. You know? Oof. What should I do? So what they said basically that the monetary limit for payment to road transport vehicle is 35,000. So here example also they gave 23,000 they made the payment. So is it allowed? If they made the cash payment 23,000, is it allowed? The answer is yes. If they made cash payment of 32,000, is it allowed? Obviously yes. What's the problem with it? No problem. But if you make payment of 37,000, that is to see, then that 37,000 is disallowed. Okay, very good. Now where an allowance has been made in the assessment year, now this is relating to 40A subsection 3A which I missed. So here I'll explain to you. There are expenditures which you can claim on due basis, correct? So we can say these expenditures are allowed, right? So when it is allowed on due basis, this section will anyhow ignore. But when you actually make the payment, you should pay through account pay check demand draft. But if you fail to do so and you make payment in cash, so now we cannot say that we will disallow it because already deduction claimed. So that's why government says in this case we will treat it as income. In this case we will treat it as income under the head profits and gains of business and profession. So when this is considered as income, suppose you are making the payment, right? That actually is now due, not yet paid, but you claimed it as deduction under income tax also, let's assume, right? In income tax also it is allowed on due basis, so you allowed it. Your income is computed and you paid the tax, everything closed. But later on you actually made the payment in cash. It's unfair, right? You should abide by the rules. So what government says, no problem, will whatever cash payment is done, will treat it as deemed income and tax it under pgbp. So same thing is explained through example. Mr. X, now this section 40A subsection 3A. Okay, Mr. X purchased goods on credit on year you ignore 7th July for rupees 60,000 and claimed the expenditures as deduction in the assessment year. On 7th July, he paid to creditor rupees 60,000 in cash. Now you claimed it as deduction earlier. Now you are paying in cash 60,000. Is it allowed? The answer is no. But it will become income. So since amount has all been paid in cash in excess of rupees 10,000, correct? Therefore, the allowance originally made shall be considered as income. So whatever allowance was made originally, that will be considered as income. Okay, in this case 60,000, I feel, if I am wrong or right, I don't remember. I have to see the number. Yes, 60,000 is right. 60,000 will be treated as income. Now last few things are left. So with all the examples, we understood one thing under section 40A, subsection 3 and subsection 3A. One thing we understood, that if the payment is on a single day to a single person on a single bill, right? Single day to a single person on a single bill in cash, more than 10,000, entire amount disallowed, right? Then we understood under 40A subsection 3A that suppose you claimed the expenditure as deduction on due basis, already allowed as deduction, but later on when you actually made the payment, you made the payment in cash. That means you defaulted this section 40A subsection 3. Then whatever amount was there, right, that 60,000 in the example, the entire amount will be treated as income from business and profession. Similarly, there are two more provisions. Provision for gratuity under section 40A subsection 7. It simply says two things. Hey, dekho, it is like a strict parent. These two sections are introduced. Said, no, provision for gratuity will not allow. Like a strict parent, they said. Then they said, is it approved gratuity? Then it is allowed as deduction. So are you able to understand how the logic is? Simply, any provision for gratuity paid by the employer. Hey, employer is creating some provision every year so that when the employee retires, the employer can pay lump sum amount to that employee. But this is disallowed, they said directly. But then they said, no. If it is approved gratuity as per the Payment of Gratuity Act 1972 or any other gratuity fund recognized by the government, then it's okay, allowed as deduction. What's the problem? That's how they said. If the provision is created in the last year of the employee, suppose employee is retiring in the current year and this year only at the start some provision is created, then also government says, अरे यार अब नहीं करेगा तो कब करेगा provision, right? So in the last year if the provision is created, government says okay, it is allowed as deduction. Now that as per the act, approved gratuity act, that is different and this is different. Okay, mostly in your exams they will say approved gratuity fund, so you can say allowed, and unapproved gratuity fund, not approved gratuity fund, disallow. And when it is disallowed, what will do? हाँ ऐसा मुंह देखो तो होता क्या, बोलना ना कुछ तो, थोड़ा बोलो तुम भी. You also say something. What it says basically, that if it is not approved gratuity fund, then it is disallowed. That means if debited to P&L account, you will add back to find the income, business income. Same way, contribution to any fund under section 40 capital A subsection 9. If any contribution to the fund is done by the employer. Now who is contributing to the fund? Employer. Is it allowed as deduction? The answer is absolutely no. No, sorry. It is generally no. But if it is recognized provident fund, if it is approved superannuation fund, if it is new notified pension scheme, so government says okay, these are allowed, no problem at all. So in the question they give that employer contribution to NPS, employer contribution to provident fund, recognized provident fund or EPF, or they give employer contribution to the superannuation fund, approved superannuation fund. They debit all these to P&L account. Ignore. Arey yaar, it is allowed and they debited it. So ignore. But if they say employer contribution to unrecognized provident fund debited to P&L account, are not allowed. So what should we do? So we'll say disallowed. So what should we do? Add back to the profit to find your business income. Okay. So all the sections under section 40, everything, whether it is 40 small a, clause 1, 1a, 1b, 40 small a, clause 2, 2a, 2b, 40 small a, clause 3, clause 4, clause 5, we did 40 capital A subsection 2, capital A subsection 3, capital A subsection 3a, we completed all that, right? Then we discussed about gratuity, we discussed about that 40 capital A subsection 7, other fund 40 capital A subsection 9, everything we did, right? Like this we should learn the concepts. We'll meet in the next lecture. Till then, take care. Bye everybody.